think the post-pandemic price bubble would eventually pop? Think again. 3 years ago, you grimaced at eye-watering markups just to get a truck that actually existed. Fast forward to 2025, and those same trucks are still flirting with 50 grand price tags, sometimes higher, while dealers slap market adjustment stickers around like clearance tags at a warehouse sale. Fast, casual, and on everything in sight. Average new car prices hover near $49,000, the highest plateau on record. Yet crosstown lots aren't empty. Far from it. Inventory is healthier than in the drought days of 2022, but tariffs, union wage hikes, and a tight used car pipeline keep the retail price mountain stubbornly high. In the next few minutes, we'll break down why the climb isn't over, how dealers still squeeze extra profit in a so-called balanced market, and what you can actually do to avoid a wallet-wrecking mistake before summer ends. Stay tuned, because missing one detail in this high-stakes puzzle could lock you into an $800 payment until 2031. Early April inventory reports showed roughly 2.69 million new vehicles on hand, about 70 days of supply. Sounds comfortable, right? But that number actually fell from 91 days just 6 weeks earlier, thanks to a tariff panic buying spree in March. Here comes the tariff bomb. A blanket 10% tax on all imports, plus an extra 25% duty on cars and parts, makes every vehicle with even one foreign bolt more expensive before it ever reaches U.S. shores. Automakers figure that adds roughly $2,000 to $12,000 per car, and they stick every dollar onto the price tag. Add the 25% wage hikes that union workers secured for the next few years, and factory costs climb higher still. Even non-union plants have boosted pay to stay competitive, locking in higher break-even prices across the industry. What's the result? As MSRP seldom falls, incentives stay modest, and shoppers waiting for a 2019 style clearance event are still waiting. But if the sticker is bad, the add-on culture is downright brutal. Scroll car forums, and you'll see screenshots of Civic SI quotes north of $40,000, $6,000 to $7,000 above sticker for a 200 horsepower compact. Likewise, try ordering a hybrid pickup or a GR badged anything, and the finance desk will likely slide a market adjustment line item across the table. Why? Allocations on buzzworthy models remain thin, and dealers now rely on markups to offset slimmer margins on mainstream metal. Traditional haggling hasn't died, it's mutated. Where once you battled over a few $100, now you're negotiating the existence, not the size, of a $5,000 fee. Some stores disguise it as protection package, others as limited availability surcharge. The best defense: widen your search radius, call rural dealers first, and arrive with written out-the-door quotes in hand. Of course, beating the markup is only half the war. The other half is the loan staring you down. Average APR for new car loans clocks in at roughly 7.3%, with many prime borrowers seeing offers above 7%. Subprime? Brace for 12% or worse. Pile that on a $49,000 purchase, and you're looking at a $920 monthly bill over 72 months, before taxes and insurance. No wonder delinquencies are spiking. Subprime borrowers 60 days behind hit 6.6% in January, the highest since the Great Recession. Lenders respond by tightening standards, shrinking the approval pool, and nudging borderline customers toward buy here, pay here lots at even uglier rates. Dealers counter the payment shock by stretching terms to 84 months, sometimes 96. Sure, the monthly looks friendly, but depreciation outpaces payoff by year 3, locking owners in negative equity hell if they try to trade early. If new is rough, maybe used offers relief? Spoiler, not really. Remember the 2022 leasing collapse? That decision is haunting 2025. Roughly 2 million off-lease vehicles that should have hit auctions this year simply don't exist. Dealers fight over every 2-year-old crossover that shows up, and Manheim wholesale prices quietly ticked up for 4 straight months. Consumers hoping to buy used to save face a double whammy: 11% average APR on used loans and wholesale costs that still sit 35% above 2019 levels. New tariffs hit used inventory too. Imported parts for reconditioning cost more, nudging retail prices higher. In short, used remains a smaller, pricier pool, especially for low-mileage units, leaving many buyers circling back to new car showrooms despite the heartburn. But the priciest corner of the lot is electric. Let's tackle that next. Average transaction price for a new EV hovers around $58,000, a cool 9,000 above the all-segment average. That hurts, but the real sting lands on September 30th, when the $7,500 federal tax credit disappears. Automakers are already dangling free home chargers and low APR leases to pull demand forward into the third quarter. Expect sudden scarcity on popular EV trims in August, ironically sending transaction prices higher, at least temporarily. After the credit expires, analysts predict a 27% registration drop, but don't bank on an immediate fire sale. Manufacturers will trim production before they slash MSRP. In other words, the EV deal of the century may never materialize, and early adopters could stay upside down well into 2027. So how do you, the sensible buyer, avoid financial carnage in this market? Here are 8 smart moves to keep your wallet safe. Grab a pen. 1. Get pre-approved at a credit union. Credit unions usually offer interest rates 1 to 2% lower than what a dealer can arrange. 2. Order straight from the factory if you can. When you build the car yourself, the price already includes the dealer's profit, so they have less room to tack on extra fees. 3. Shop for certified pre-owned cars. These used cars often come with short-term loans around 5% interest, better than most regular used car rates. 4. Widen your search area. Dealers in small towns or less busy markets often skip markups just to move inventory. 5. Pick the uncool models. Mid-size sedans and basic minivans get bigger discounts because fewer people want them. 6. Buy during model year changeovers. Late August through September, dealers slash prices to hit sales quotas as new models arrive. 7. Consider short-term car subscriptions. Some brands let you pay month to month for 6 or 12 months. Costly upfront, but no long-term commitment if prices drop later. 8. Lock in the out-the-door price. Make sure the final number includes taxes and fees, so surprise add-ons don't blow up your payment. Even with these tricks, the big question remains: when will prices finally cool off? Stay tuned. I bet you were asking, what might finally push prices down? Lower loan rates are on the horizon. If the Federal Reserve cuts interest rates a couple of times, 5-year auto loans could dip to about 7% by year-end, translating to smaller monthly payments. Tariffs may ease. Automakers and parts suppliers are lobbying hard to roll back the recent import taxes. Industry chatter says a deal after the election could start trimming parts costs by the middle of 2026. Lots of new models are coming. Car companies plan to flood the market with 2026 releases. If dealer lots get too full, say more than 80 days of supply, they'll sweeten the pot with bigger rebates and discounts next spring. Bottom line, prices really can soften, especially if you can hold off for a year or so. If you need wheels sooner, lean on the money-saving moves we covered earlier, and keep an eye on one more wild card. The way cars are sold could change next. Legacy automakers eye Tesla's click-to-buy model with envy. Several pilot programs now let shoppers build online, secure financing, and take delivery at home, sidestepping the showroom markup dance. Yet entrenched franchise laws still protect dealer territories in most states, so true direct sales remain a patchwork. For now, brick-and-mortar stores retain leverage on hot inventory, but the tide is shifting. As online end runs gain legal traction, markups could erode. Dealers see the writing and diversify. Service centers, subscription fleets, even classic car storage, anything to offset slimmer new car margins. But until laws change nationwide, expect at least one more model cycle where dealers wield the Sharpie over MSRP. The 2025 car market is stuck at sky-high prices. Tariffs, higher wages for workers, and expensive loans all push costs up, and uneven supply means buyers don't have much leverage. Still, smart moves, ordering straight from the factory, timing your purchase right, hunting in small-town dealerships, and using a credit union loan can knock thousands off the price even now. So, are you gearing up to battle the current peak or holding your cards for a softer 2026? Drop your plan in the comments below. If this breakdown helped demystify the madness, tap that like button. Subscribe for the next hard-hitting market watch, and I'll see you when the deals get sweeter in the next video.